Hello, traders. FS Speculator here. Today is. Oh, sorry. Hello, traders. FX Speculator here. Today is Wednesday, and it is the big FOMC day. So, how is everybody doing today? Nice to see everybody. Hopefully, everybody's doing fairly good. Definitely a little bit of volatility today for sure, leading up to this news event. So today is the federal funds rate for the U.S. They are not planning on lowering interest rates. Now, even if they don't lower interest rates, I would definitely expect to see some volatility in the market. I mean, this is a very big news event. This is definitely one of the bigger news events of really the month. It only comes out every 6 weeks or so, anyways, but definitely a very big news event. Everybody is expecting that they are not going to be lowering interest rates, even though there is definitely a lot of pressure from Donald Trump to lower rates. More than likely, they probably are not going to lower rates, but if they do lower rates 25 basis points, then it definitely should be a big surprise to the market. And when there is a big surprise to the market, that's when you're likely to get a big old giant ripping move. And then the press conference is 30 minutes after the news release. And just keep in mind that normally the market during the press conference, especially the Q&A, the questions, that is normally when the market decides on whether it's going to hold a move or not. A lot of times we get a big move at the news and it'll go all the way back to the starting line, maybe even bounce in the other direction, go back to the starting line. And then during the press conference, a lot of the times is when it'll either, go up or potentially go down or whatever it decides to do. So, anyways, we only got about a little less than 15 minutes, 12, 13 minutes. Yeah, 12 minutes until news comes out. So, let's real quickly just kind of go through these pairs real quickly. And then we're going to have to reevaluate afterwards. But I totally get that the dollar pairs really look like they should make a significant pullback. This is the pound dollar on the daily. This is obviously a very big resistance area right here. I mean, you would definitely expect that to potentially make a much bigger pullback. And if this really is a complete five-way pattern up, then it definitely would make a very big pullback for potentially a larger move to the downside, like a wave two. The whole thing is there's really nothing stopping this thing from continuing the uptrend. Now we are at the 78% Fibonacci retracement. There's definitely a lot of resistance right here. So, I mean, I'm kind of with everybody else, which I think is kind of a problem when thinking that this is probably going to go down. The problem I'm having is that pretty much everybody I think is thinking the same thing, which usually is kind of a red flag for me. Now, the euro dollar, same type of thing. I mean, you would expect to see a much bigger move to the downside. You would expect to potentially even see something like this, maybe. So, I do agree that most of these dollar pairs do look like they should make a very big move to the downside, like the Aussie dollar. I mean, it potentially could do something like this and then continue the uptrend for like a wave one, wave two, and wave three. So I totally agree that most of these dollar pairs totally look like they're going to go down before they go up. And this is the daily time frame, so you have to keep in mind if it does go down, it's probably going to take, several days for it to complete. So it's not like it's probably going to go down and then back up all in one day. US dollar CAD, kind of the same thing. I mean, you almost kind of think that the trend ends here, and this is almost like an irregular ABC or possibly like an expanding or running flat, and then it just ends up continuing a downtrend, in a week or two. US dollar Swiss, kind of the same thing. I mean, we did make a pullback. We definitely had a very clear five waves right here. So we definitely did have a pretty nice pullback, but this pullback did not even reach the 38% Fibonacci retracement. So it kind of would make more sense on this one also, I think, if it went up, maybe even for a week or two before it actually ended up continuing the higher time frame downtrend. And gold is definitely a little bit of a different story. I mean, gold in my mind is kind of a tough one because I could personally see gold being $5,000 an ounce a year from now. I mean, I definitely don't see any reason on the very high time frames why gold may not reach, $4,500 an ounce, $5,000 an ounce over the next year. So keeping that in mind, going down to the sort of time frames, I totally agree that it would make more sense for this to go down pretty significantly before it went up again. The problem is like I said, I feel like gold could go up to $4,500 an ounce and even higher. So there's a big demand for gold right now. Now, even if this really is a wave B, I feel like what's going to happen on gold is it's going to go down and grab liquidity, and then it's probably going to go up and take these highs, probably go up to the 278, 261.8, and then it's probably going to start a much bigger move to the downside. Definitely not all happening in one day or one move, that's for sure. I mean, it's probably maybe going to do a spike down and then reverse back up would be my guess on gold, definitely. And there's a few other things too to keep a watch on. I mean, obviously you want to keep an eye on the indices. You know, the S&P 500, the Nasdaq. I made a video about the Nasdaq yesterday, and I made a video about S&P today. But I really do not think that these moves up are finished. I do think there's a chance that this is a wave B, and I do think there's a chance it might go down. But I feel like this is not the end of this move. I think it potentially is going to go up because it should take out this high, even if it really is a way B, it really should take out that high before it starts to move to the downside. And when we're talking about the stock markets, I mean, you really have to consider that it could just go and go and go and go, because especially on something like the S&P 500, you have to kind of realize that this is a never-ending uptrend. So every single time you see a pullback, you should expect that to be nothing more than a pullback within a basically never-ending uptrend. Now we have some really, really smart people like Ray Dalio, which I'm a big fan of his books. He's got a new book coming out soon. But there's a lot of people saying that we're going to be in a 5 to 7 year recession because of the economic cycle that we're in right now. And I do like Ray Dalio. He's made some fantastic predictions. So he might be right. You know, this potentially could make a pullback that lasts years before it actually goes up and makes a new high. So we'll have to keep an eye on those pairs over the coming months, definitely. Yeah, I can check stuff like that. So after the news comes out, which the news is in 7 minutes. So after the news comes out, I will go through and I will check. I'll take requests because there's going to be a half an hour between when the news comes out and when the press conference starts. So in that half an hour between the news and the press conference, I'll take requests. So, you know, if you want me to look at Boeing or at crypto or pretty much anything, then I'll definitely do that. Oh, I know. The last couple of weeks have been very, very slow. I much prefer to trade like the 2 to 4 hour time frame personally. I like to be more of a swing trader. And when you're in these type of market conditions, you know, it's not uncommon to kind of sit on your hands for a little while. I mean, I've been kind of scalping the euro dollar a little bit this week. What's my idea of scalping is holding on to a trade for like 8 hours, you know, because I'm used to holding on to trades for like a week or more, you know, a few days at least. So yeah, sometimes you have to adapt, kind of go down on a little bit of a shorter time frame, I guess. Even though it's definitely not what we may not be what we want to do. I think that it would make way more sense for this to potentially go down to maybe the 50% and then go up to about the 72, 78% on gold. It really looks like it needs to make a more proper ABC correction before it continues up. And with this big news event we got coming out, I mean, I wouldn't be surprised if it was like a spike reversal too. You know, maybe a spike reversed. And keep in mind that this news event right here often causes what we always joke about in my group as the porcupine pattern. The porcupine pattern is when the news comes out and it just makes like a huge move within like a minute, and then within like 10 minutes, it's all the way back to the starting line. Which is why, I mean, you could try to scalp a move right at the beginning of the news and like hold on for like 1 or 2 minutes. But odds are, more times than not, price is going to come all the way back to where it was before the news came out, before it really decides on a direction. Oh, yeah, US dollar yen, boy. It's a hard. I mean, the thing with the US dollar yen is that it made three waves up to a fib level already, so. On the daily time frame, look at that. That's three waves up right there. One, two, three waves up to a 50% fib. I really wouldn't be surprised whatsoever if this thing just keeps on going down. I'm not in any trades right now. I traded a little bit earlier, but I went flat about an hour and a half ago because this is a little bit gambling if you're trading this news event. I mean, I could be 100% right about my daily time frame direction, but if I try to go, you know, long or short on these sort of time frames, the thing could go down, stop punch you if you go long, and it could go up and stop punch you if you go short, and then it could end up drifting, you know, one way or the other afterwards. So it's definitely a little bit of a gamble. I don't really trade. Hey, Yamberry, how's it going, buddy? I don't really trade it, and if I do trade it, it's usually like $50 on my $100,000 account. So it's like literally like 0.005% risk or something because it is definitely gambling. If I had to guess, which honestly it is a little bit of a guess, I would kind of think that it might go down, grab liquidity, and then go up. I don't know. I feel like too many people are trying to go short on this thing. Yeah, definitely. That's what I'm doing now is for distance just for fun. I mean, I definitely do have a direction. Definitely do. At least on the higher time phase, I do. I feel like this needs to go up more. I think it needs to go up and take out these highs. I think too many people are thinking it's going to go down, and then maybe like in a couple of days it will go down in a bigger way, kind of completing what I think is more like an ABC, even though it doesn't really fit very well as an ABC, but it is three waves. I don't know. It doesn't really fit too well. Almost kind of makes you think that this is one, two, three up, one, two, three down, and then either three up or five up, and that's just going to be more sideways price action. We have to keep in mind that if they do not change the funds rate, it probably is just going to be some very short-term volatility. Boy, the pound dollar also kind of looks like it could keep going up. It kind of looks like it could keep going up, in my opinion. I feel like the euro dollar, pound dollar, all these pairs, they might spike down a little bit, but I feel like they could go up, which I think is totally opposite of what most people are thinking. Which is usually, I try to be a little bit contrarian when it comes to these news events because a lot of times they are just stop hunts. A lot of times the first move is nothing more than a stop hunt, especially on the Aussie dollar. Oh, the Aussie dollar is very strong. Ooh, US dollar CAD is definitely going up a little. I don't disagree about the dollar CAD. I mean, it looks like it should go up. It almost looks like the trend ended right here. One, two, three, four, five waves down. Kind of almost looks like this is like a little wave A. This is a wave B. Now it's going to go up and make a wave C, take out the highs, and then maybe in a day or two go down. So we're going to have to see. I mean, even the US dollar Swiss to me looks like it broke structure, right? So you got impulsive up, break a structure. You got three waves down. It looks like it should go up. So I mean, I think the dollar might go up, but I think there might be a little bit of a down push before the move up. So dollar up potentially means euro dollar, um, spike reversal like that probably stop out everybody that thinks it's going short, which it probably will go short eventually. I think there's going to be a spike reversal to the upside. That's my prediction. I think gold is going to make a spike reversal to the downside if there is a big move. And, all the other pairs, same type of thing. But let's see. Let's see what happens. Boy, what do we got? 15 seconds. I'm not in any trades. I'm just going to let it be. Let's watch it right on the 1 minute time frame. That's too much. I can't watch it on the 1 minute. 5 minute time frame. Here we go. Be nice to see a big old giant move. They're probably not changing rates, I would imagine. I really don't think they're going to end up changing interest rates. I'm logging into my trading account just in case I do get excited and want to put like 50 bucks risk on or something, which I kind of do, but it's a little bit of a gamble. Nah, no change in rates. They kept it the same. I mean, that doesn't mean that the market potentially isn't going to make a significant turn, but it just means that nobody's surprised. And there's no surprise. When there's a big surprise or there's a lot of agreement in the market, that's when you get big giant moves. And when there's no surprise, there's probably not going to be a big giant move. That's kind of disappointing a little bit, though. I hate that. Yeah, I know. They kind of knew that they weren't going to cut. Everybody was saying that. The UK is supposed apparently cutting rates tomorrow, right? Yeah, tomorrow's Thursday, so yeah. Apparently, 25% rate cut tomorrow for the UK. Honestly, tomorrow's UK news might be more interesting than today's dollar news because at least they're doing something, cutting rates. Bank of England at 12 o'clock. There's probably a press conference for this too, isn't there? Okay, was it on Friday? Was it a press conference Friday morning for the Bank of England? Must be. I'm sure there is some sort of a press conference for that. Let's see if are they moving? Let me check my other chart real quick just to see. Boy, I am kind of tempted, to be honest with you. Hmm. Yeah, not much going on, huh? I'm gonna put a little bit of play money on the line, but definitely not much. Definitely not much. And I'm using a big stop loss. So, let's see here. All right, so I guess we'll have to take some requests and stuff. That's kind of disappointing, definitely. If anybody has any requests, put them in the chats. And I mean, I think it would make more sense for them to finish their move to the upside, to be honest with you. And all the higher time frames are definitely agreeing with the momentum is up. I mean, you can't really look at this time frame and say that the momentum isn't up. And I know we're at a resistance area, I get that, but when the market's trending, it doesn't always have to bounce at a resistance area for long. This is a good example of a resistance area, a support area that just made a little zigzag and then just kept on going. A little zigzag and just kept on going. Yeah, no rate change, unfortunately. Definitely a little disappointing. Yeah, now we gotta get ready for Powell. I already got the YouTube channel queued up, the FOMC official YouTube channel. Let's see what he says. There's a ton of pressure on Powell right now to raise rates, to lower rates. I'm sorry, to lower rates. Trump really, really, really wants lower rates big time to help promote business more than anything. His whole plan is is to lower rates, make the dollar cheaper, and uh, bring manufacturing back to the U.S. But people are definitely going to suffer with a little bit of inflation probably in the meantime. So, anyways, definitely don't want to get into politics here. We got Powell coming pretty soon. We got Powell in 26 minutes. Excuse me. So, if anybody has any requests, put them in the chats. I'll be more than happy to look at anything. I can look at stock market, crypto. I can look at anything. It really doesn't matter whatsoever. We got about 30 minutes until the speech starts. I mean, even though it's kind of slow right now, I wouldn't, take off now because unfortunately, the press conference is when you are likely to get a big giant move. So, 30 minutes from now, when Powell shows his face and starts talking, depending on what he says, he already said in one of his last press conferences that they were very likely to do 2 to 3 cuts this year. So, if the economy stays as it is, with PMI and all those numbers have come out pretty positive for the U.S. lately. So I think there's a good chance that they will cut rates next time. I think next time there's a good chance they probably will do 25 points. Is the dollar yen going down? Yeah. Look at that too. A nice fib bounce, honestly. Look at that, 38%. Impulsive up, corrective down, little. It's kind of almost like a WXY. Need to see a break of structure to confirm, but the trend is definitely down. Yeah, well, apparently, the UK and the US are pretty much already worked things out. They're pretty much like going to be like charging each other almost nothing. So it's, he's willing to make deals, but the problem is some countries don't want to make deals. China, I've been watching some videos about China, and they're definitely not into any deals, that's for sure. Yeah, not a lot going on there. Let's see, what was about, what trade should I have held my trades? I was short the, oh, okay, good thing I got out. I was short the Euro pound today. Got out of that. right there. I was also short the Euro CAD today, which good thing I got out of that one also. I had a feeling I should have got out of my trades. I got long on gold, but it didn't really do anything, so I got out. I'm not really much of a gold trader anyways. Hey guy, hey, how's it going? Nice to see you guys. Ah, nice. Hey buddy, how's it going? And what else did I trade today? I did try to go long the Aussie dollar. I went long there and got out there, so not much there. Pound dollar was a good trade. Went long the pound dollar today, and the Euro CAD was a really good trade. Went short that. Boy, some of these other pairs are moving pretty good actually. Let's see here. Give me 1 second. Some stuff is definitely starting to move. Oh yeah, nice. Nice. So I wanna take profit. So, anyways, yeah, let me start taking my quests. Let's see. US dollar Swiss is starting to move, huh? Yeah, down. Look at that. Good timing. Trend is your friend. One thing about the US dollar Swiss that I think so many people are missing is this higher time frame picture. We broke structure and we made a pullback back to structure, and now we're probably going to push down to the 78% Fibonacci retracement, which is all the way down to 0.78, and it might not even stop there. It might just bounce again and keep going, but trend is your friend, that's for sure. Man, I never did hit a good fib level though. I would have liked to have seen a 38% fib bounce. I mean, it came close. It didn't get it though. Still kind of makes you wonder if it could pop up at some point, but I guess it doesn't really have to hit a fib level all the time. It definitely does the majority of the time. Oh, gold's starting to push up. I probably should have just stayed long on gold, but gold's not really my pair. I never was a gold trader because I always traded my own personal funds living in America, and you can't trade. Ooh, you can't trade that in America. You can't trade gold in America on a margin account. So let's see here. Dollar's starting to push up. It might not. I don't know. We'll see what happens when Powell starts talking. I think that it would make more sense for the euro dollar to take out this high, do like a double top, and then start a move to the downside to make more of a proper ABC. I think there could be like an expanding ABC or something inside here for the wave B, and then go down for the wave C is what I think is more likely. But pretty choppy market, that's for sure. I'm like I said, I think I'm more excited about tomorrow's pound news at noon. That should be a pretty decent one, and pretty much, I think it's pretty likely they're going to do at least a 25 points. Let's see. So, what do we got for requests? I keep turning off the chats. US dollar Mexican. US dollar Mexican peso is not a pair that I've ever traded, but I've honestly have known many people that do trade that. I don't even think my broker offers it. The one that I have in Europe, I don't think they even offer this as a pair to trade. I would I would expect us to be in a wave two, to be honest with you. But it could be some sort of a running thing. I don't know though. That's definitely a trend right there. That's definitely a trend right there. That's definitely three waves. So that means this would be a trend, correction, trend. I think we're in a wave two. I would expect this wave two to go down to at least a 61%. Seems like a really likely place for it to go. Yeah, no problem, Skywick. I'll check out the Aussie dollar a little closer. That Aussie dollar is one strong beast right now. I mean, I have a hard time suggesting anything but longs on that pair. I think all the Aussie pairs, like literally every single Aussie pair, has found a bottom on the higher time frames potentially. I think there's a good chance this is going to go down to the 38%. Then we're probably going to make another pullback, and then we're probably going to go down to maybe the 60 or the 78%. 61% or 78% fib. I think that we're in a wave two. And that'll probably give time for a lot of the other dollar pairs to finish their move before the dollar does reverse. Because I do think the dollar is in a wave C. I do think the dollar is going to go up. No, this is the DXY. I do think the dollar is going to go up at some point. I think it's going to go down for pretty much all year, but then maybe next year it's going to get strong. Especially if you look at the DXY. I think this is a wave C. I think it's going to go down more though. And then I think it's going to go up. I think it's going to go down towards these lows, and then I think it's going to go up and grab these highs. I don't really analyze the DXY. That's why I don't have any labels on it. But US dollar index, same thing. You just can't see as far back on that one. So keeping that in mind, boy, I still think that we found a bottom on the Aussie dollar. At least not a true bottom, but a temporary bottom, like a 2 year bottom maybe. I think that we're now in 1, 2, 3 waves up for wave Y. I think it's going to go all the way up and test these highs. I think the Aussie dollar is going all the way up to about zero point 0.8 before it potentially goes down again. That's the monthly time frame outlook, but I really, really, really like analyzing the higher time frames. They're very trustworthy. Then you go down to the shorter time phase and you start coming up with completely different analysis. I 100% agree with anybody that says this looks like an ABC because it definitely does. And all the dollar pairs kind of have that same type of look to them, like they potentially could do this, which on the 4 hour time frame would probably be all this week and probably most of next week. So I totally agree with anybody that says that. The problem is that I'm so bullish on the higher time phase. I also would not be surprised if it either made a higher low and kept going, or it maybe took out the lows and made like an expanding ABC and then kept on going. I really wouldn't be surprised whatsoever if all these dollar pairs stay bullish pretty much all year, and then maybe next year. But we'll see. Yeah, I think it'd make more, like I said, based on the 4 hour time frame pattern, I definitely think it'd make more sense for this to go down, and not just a little bit either, probably like something like that. So totally agree with anybody that thinks that. Definitely looks like it. And a lot of these other pairs kind of have the same type of look to them. I was kind of thinking the pound dollar might pop up, got this high, and then go down. And same type of thing on the euro dollar. I was thinking that we were going to get another pop up, grab some highs, then go down. NDX and VIG. I don't know what VIG is, and I'm not NDX. I'm not sure what NDX is either. Is that crypto or stock? Wow, how boring. Man, the markets are boring right now. This is like what happened last time Trump delayed the tariffs, if you guys remember. The last time Trump delayed the tariffs was right here, and now he delayed the tariffs again, and this is exactly what's happening again. Oh, VIG is an oil tanker? I can check it out. So last time he delayed the tariffs, it lasted about 30 days. I would even argue, yeah, about 32 days or so. How long has it been now? I know he delayed the tariffs this time, 90 days for most people. 30 days would put us out until the end of May, which, I'm going to be taking a week off at the end of May. I have to keep an eye on the charts, that's for sure. I'll bring my tablet with me. So, let's see here. Let me check out VIG for you. It's definitely just going to be an opinion. I got about 15 minutes until Powell starts talking, so I have time for some requests, definitely. Switzerland, oil rig from Switzerland? Swiss oil rig or something? I already have it on the list. What happened? There it is. Definitely something I've never looked at, so it's definitely an opinion, but ah. Oh yeah, a lot of these. This looks just like the other pair that Ryan had me look at, except for this one. Hasn't turned up yet. Definitely looks like it's bottoming. It's like really close to a bottom. I wonder if it's gonna take those lows right there at like 30 cents though. Probably is, isn't it? I mean, you cannot deny that this is lower high, lower high, lower high, lower high, lower high, lower high. I mean, that's literally like the definition of a trend is lower lows, lower highs, lower lows, lower highs. The trend is always your friend, that's for sure. Yeah, I bet that's still going down. I think I would have to be bearish on it still. There's no reason for me. It would have to go all the way up and take out this high for me to become bullish. So I would have to stay bearish on this thing definitely. It might go up though, like short term. I mean, after it does this, it might do something like this. But unless it goes and takes out the 100% fib, I would have to stay bearish 100%. I would definitely wouldn't be like buying for the big hold. I do think at some point this is gonna go up in a big way, like a really big way. But it could be months away. Let's go back to Forex. That's just my opinion now. Like I said, I don't analyze a lot of these type of things. So, ooh, we're past the 78% fib too. That's usually a pretty good sign that it will take out that low. So yeah, I think it's gonna go down to about 65 cents. Unfortunately, I would have to be bearish. Definitely. Pound yen. These yen pairs are also getting pretty boring lately. I mean, I know on the sort of time phase they're definitely moving, but ugh, I'm not a big fan of the sort of time phase more times than not. If you've seen my videos, I still think that it looks like a potential ABC. I still think this right here could be the top of an ABC correction. We have a one, two, three, four, five waves down. So we have, oh, no problem, anytime. So we have five waves down, we have three waves up, and this was the 78% fib before I deleted it. So I would have to be bearish on the yen pairs. If you saw my video, I said wait for a Fibonacci bounce and golfing move to the downside, three waves up, one, two, three waves up to a fib level. That's a beautiful little entry right there, definitely. I would be doing nothing but looking for shorts. I wouldn't be trying to buy it right now or anything like that. Definitely not. Same thing on the Aussie yen. Boy, the Aussie yen never hit a fib level, but I could definitely picture that being a complete correction. Looks like a wave A. Looks like this is the end of a wave B. Yeah, maybe one more wave. I don't know. One, two, three. Maybe it's a WXY or something. What's the JPY basket? Oh yeah, JPY basket looks pretty bullish also. I think I would have to be bullish the yen pairs. I don't really see them over yet. I think they're still in an uptrend, at least for now. Kind of seems like it'd make more sense for this to go up, grab these highs, and then go down and break structure, but just because it looks like five waves. But just because you see five waves definitely doesn't mean a trend is over. That's for sure. That was an entry today too. I was doubting it. I did. It's always the trades that you doubt that are the ones that turn out the best. I was looking at this earlier today, right around here, and I was like, "Oh, the trend is down. The trend is your friend. That looks like a little one, two, three-way pullback, and then it takes off without you. You talk yourself out of it." The Euro Swiss is the one that I definitely missed. The Euro Pound was a decent trade, but that Euro Swiss, whew, that was a nice one today. What's the Pound Aussie? I almost. Pound Aussie, Pound Kiwi. Boy, they do look like they want to go up, but the trend is definitely still down. They really don't want a big structure. Yo, Aussie's starting to break structure though. That's a good sign for the other pairs. Oh yeah, and the Yo Aussie just bounced from the fib level too, so that's a good sign for the other pairs potentially turning up also, like the Yo Kiwi, the Pound Aussie, Pound Kiwi. Boy, this one looks like three waves too, man. If that holds above that, I'm gonna be looking for logs because that thing could just keep on going. I just told Yenberry today that it's probably gonna be a wave B and then go down again. But boy, I still think there's a good chance this is gonna keep going up. One, two, three waves down, just keep on going. It's been doing five waves, three waves, five waves, three waves for like a year now. So until it does something different, we should just be like, okay, five waves impulsive, three wave corrective, five waves impulsive, three wave, five wave, three wave, five wave, three waves, five wave, three waves, five waves, three waves, five waves. There's no reason to think otherwise, at least not yet. So if anybody hasn't done so yet, definitely do check out my Discord channel. My Discord channel is 100% free. You do not ever have to pay a dime if you do not want to. Definitely be careful of scammers. If anybody contacts you right after you join, it is 100% not me. It's a scammer. I kick them out on a daily basis, but they just keep on coming back, so be careful of that. But definitely check out the channel. There's a lot of people in the group now that we got 5,887 members. And I really just want to build a community of like-minded traders. The free community is 100% free. Post your charts, share trade ideas, talk with other traders, ask questions. I want to build a community of people that help each other out and just share trade ideas. And, trading's not an easy business, so the more help you get, the better. Definitely. I had a pretty big watch list earlier today. It's like everything was moving. Let's see. US dollar yen. Eh. I think we gotta wait for the news now. We got Powell talking in 6 minutes. And I got that all queued up. So in 6 minutes we can watch Powell. FOMC Federal Reserve website, YouTube channel, I mean. So we can watch that. I definitely want to hear what he has to say because there is a lot of pressure on him right now to lower rates, and he still hasn't lowered rates, even though Trump has been putting pressure. I think this is the second rate news event that he didn't lower rates, even though Trump has been putting pressure on him to lower rates. So you got to give the guy credit, standing his ground. Obviously, it's not just his decision. No, it's a vote between all the states, but. So that should be good. Did gold end up moving? No, not really. Oh man, gold didn't do much. I'm glad I got out of that. I went long right here, and then I got out like right here because I was just like, this is stupid. It just like went do all day long, and I'm like, you know what? That's dumb. I think I actually got out with a tiny loss, so I got out like right there. But my stop loss was like way down here, so it was like such a small little thing. Gold it moves a lot, but every once in a while, it's just like any other pair. Every once in a while, you get sideways for a while. You know, it happens to all of them. Yeah, I'll give you the link. I'm gonna watch it. We're gonna watch it here together also, but I'll definitely give you the link so you can check it out. This is the link for the FOMC website. Oh, I think it's about to start. 5 minutes. This is the YouTube page for the Federal Reserve. Oh wow, look, they just got a they just broke the 400,000 mark while I was sitting here. That's funny. If you haven't done so yet, definitely do like and subscribe to the channel. Definitely help support my little channel. We're going to be hitting 30,000 subscribers hopefully this month. So hit that like, hit that subscribe button if you haven't done so. I make videos on a daily basis. Only Sunday is the only day that I don't make videos. So definitely do that. Help support the channel. Definitely check out my free Discord channel. And if anybody is interested, I do offer a membership, but I keep it extremely cheap because I want it to be extremely cheap for everybody. But I do like to call it Learn and Earn at the same time because hopefully when you're following along with my trading course, attending my twice a week Zoom meetings, and paying, following along with all the educational information that I provide, hopefully you can earn too at the same time by following along with some of my day/swing trades. I call myself a swing trader, but I mean, in these slow markets, you have to be a little bit more of a day trader. Otherwise, you're just going to end up holding on to a trade for a week that does almost nothing. Because, I mean, there's definitely been some swing trades here and there, but day trading is kind of where it's at when these markets are slow, that's for sure. You got to kind of adjust depending on market conditions. So if anybody's interested in joining the membership, it is only $30 a month. And it's definitely a great community of traders we got going on in there too. So it comes with a free trading course and a ton of information. There is a video on my homepage right here. If you press play video, there's a video right here you can watch that explains everything about my website, including the trading course and everything else that's offered. But you can join my channel, Discord channel, wait for free, no payment required. So we got about 2 minutes until Powell starts talking. Should be pretty interesting. I know. Tell me about it, Stefan. Huh? Jeez. The euro dollar just gonna stay flat forever, or what? I mean, we had a little bit of volatility right here, but I mean, for the most part, if you kind of cut that off a little bit, we're in a pretty tight little range. It broke out of the range one time, but besides that, this is 1 week, this is 2 weeks, this is 3 weeks. Now we're into the fourth week of really no breakout one way or the other. The euro dollar is usually one of my favorite pairs to trade too, so I hate these type of market conditions. Same thing on the pound dollar. I mean, this thing has pretty much been in a range for almost 3 to 4 weeks. Yeah, Powell is talking in 2 minutes. I'm going to turn that on. I want to hear what he has to say because, like I said, there's a lot of pressure on him to lower interest rates. And this is the second news event, FOMC, that he has not lowered interest rates. So it's going to be interesting to see what he has to say. Last time he said that he probably was going to lower rates, I think twice this year potentially, if the economy allowed it, that is. Boy, the yen pairs are definitely moving a little bit. Swiss pairs moved really nice today. That was kind of the trade of the day was the Swiss pairs. Yeah, I mean, if you were up for the Asian session, the Aussie pairs definitely did move too. But the entry happened at 2 o'clock, 3 o'clock in the morning my time, so definitely not a trade I took. Popcorn time. Get your popcorn. Get your cerveza. Get ready for Powell. Boy, the Aussie Swiss made a really nice push down today. Wow. Unfortunately, that started at midnight, 1 o'clock, 1 a.m. my time. At 1 a.m., I'm hugging my pillow pretty hardcore. Definitely not trading. I sleep like a baby. So we got Powell starting. Let's see here. I got the FOMC website all queued up. Here it comes. Hopefully you guys can hear it. I'm definitely not like a audio guy or anything like that, so hopefully you guys can hear. Is this working still? Let's see. Test, test, test. Good to go. Might have to adjust my settings a little bit. Oh, here it comes, and I can't even hear it. Hello, here we go. All right, Powell's out. Let's listen to see what he has to say. Oh, hold on. Wow, what is going on? Inflation has come down a great deal, but has been running somewhat above our 2% longer run objective. In support of our goals. There we go. Geez. Sorry about that.
By providing key financial services to appear to have risen.
All right, now we're good.
The current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I will have more to say about monetary policy after briefly reviewing economic developments. Pardon me. Following growth of 2.5% last year, GDP was reported to have edged down in the first quarter, reflecting swings in net exports that were likely driven by businesses bringing in imports ahead of potential tariffs. This unusual swing complicated GDP measurement last quarter. Private domestic final purchases, or PDFP, which excludes net exports, inventory investment, and government spending, grew at a solid 3% rate in the first quarter, the same as last year's pace. Within PDFP, growth of consumer spending moderated, while investment in equipment and intangibles rebounded from weakness in the fourth quarter. Surveys of households and businesses, however, report a sharp decline in sentiment and elevated uncertainty about the economic outlook, largely reflecting trade policy concerns. It remains to be seen how these developments might affect future spending and investment. In the labor market, conditions have remained solid. Payroll job gains averaged 155,000 per month over the past 3 months. The unemployment rate at 4.2% remains low and has stayed in a narrow range for the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggest that conditions in the labor market are broadly in balance and consistent with maximum employment. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Total PCE prices rose 2.3% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices rose 2.6%. Near-term measures of inflation expectations have moved up, as reflected in both market and survey-based measures. Survey respondents, including consumers, businesses, and professional forecasters, point to tariffs as the driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5% and to continue reducing the size of the balance sheet. The new administration is in the process of implementing substantial policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. The tariff increases announced so far have been significantly larger than anticipated. All of these policies are still evolving, however, and their effects on the economy remain highly uncertain. As economic conditions evolve, we'll continue to determine the appropriate stance of monetary policy based on the incoming data, the outlook, and the balance of risks. If the large increases in tariffs that have been announced are sustained, they're likely to generate a rise in inflation, a slowdown in economic growth, and an increase in unemployment. The effects on inflation could be short-lived, reflecting a one-time shift in the price level. It is also possible that the inflationary effects could instead be more persistent. Avoiding that outcome will depend on the size of the tariff effects, on how long it takes for them to pass through fully into prices, and ultimately on keeping longer-term inflation expectations well anchored. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. As we act to meet that obligation, we'll balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. We may find ourselves in the challenging scenario in which our dual mandate goals are in tension. If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close. For the time being, we're well positioned to wait for greater clarity before considering any adjustments to our policy stance. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on inflation dynamics and the implications for our monetary policy strategy. Our review includes outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference next week. Throughout this process, we're open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Steve.
Steve Leisman, CNBC. Thank you, Mr. Chairman, for taking my question. A lot has happened since the last meeting. There have been tariffs put on, tariffs taken off, and meanwhile, there's a bill advancing in Congress. And I just wonder if I could press you on the last part of your statement. Are you any closer now to deciding which side of the mandate is going to need urgent care first?
Well, so as we noted in our statement, post-meeting statement, we've judged that the risks to higher employment and higher inflation have both risen. And this, by the way, of course, is compared to March. So that's what we can say. I don't think we can say, which way this will shake out. I think there's a great deal of uncertainty about, for example, where tariff policies are going to settle out. And also, when they do settle out, what will be the implications for the economy, for growth, and for employment? I think it's too early to know that. So, I mean, ultimately, we think our policy rate is in a good place to stay as we await further clarity on tariffs and ultimately their implications for the economy.
Hearing you describe what you're looking for in terms of being able to make a decision, it sounded like that's a long-term process before you sound like you're going to be comfortable, or the committee would be comfortable to act on what the data is telling you.
I don't think we know. I think if you look where we are today, we have an economy that, if you look through, the sort of distortions in Q1 GDP, you've still got an economy that looks like it's growing at a solid pace. The labor market appears to be solid. Inflation is running just a bit above 2%. So it's an economy that's been resilient and is in good shape. And our policy is sort of modestly or moderately restrictive. It's 100 basis points less restrictive than it was last fall. And so we think that leaves us in a good place to wait and see. We don't think we need to be in a hurry. We think we can be patient. We're going to be watching the data. The data may move quickly or slowly, but we do think we're in a good position where we are to let things evolve and become clearer in terms of what should be the monetary policy response.
Nick.
Nick Kimmerer, Chair Powell, there's naturally a lot of around 2021 and supply shocks, but there are some who argue that the current situation has notable differences. Energy costs are down, housing imbalances look nothing like they did 4 years ago, labor demand appears to be gradually cooling with wage growth running below 4%. What do you see right now that could nourish higher inflation beyond a rise in goods prices this year?
I think the underlying inflation picture is good. It's what you see, which is inflation now running a bit above 2%. And we've had basically decent readings in housing services and non-housing services, which is a big part of it. So that part, I think, is moving along well. But there's just so much that we don't know. I think, and we're in a good position to wait and see is the thing. We don't have to be in a hurry. The economy has been resilient and is doing fairly well. Our policy is well positioned. The costs of waiting to see further are fairly low, we think. So that's what we're doing. And we'll see. The administration is entering into negotiations with many countries over tariffs. We'll know more with each week and month that goes by where tariffs are going to land. and we'll know what the effects will be when we start to see those things. So we think we'll be learning. I can't tell you how long it will take, but for now, it does seem like it's a fairly clear decision for us to wait and see and watch.
So when you say that you don't need to be in a hurry, does that mean that could the outlook change in such a way that a change in your stance could be warranted as soon as your next meeting?
As I said, we are comfortable with our policy stance. We think we're in the right place to wait and see how things evolve. We don't feel like we need to be in a hurry. We feel like it's appropriate to be patient. And when things develop, of course, we have a record of we can move quickly when that's appropriate. But we think right now the appropriate thing to do is to wait and see how things evolve. There's so much uncertainty. If you talk to businesses or market participants or forecasters, everyone is just waiting to see how developments play out, and then we'll be able to make a better assessment of what the appropriate path for monetary policy is. So we're not in that place, and as that develops, and I can't really give you a time frame on that.
Donna.
Janelle Marte with Bloomberg. So many economists have been pricing in higher odds of a recession, and several are noting that it is more difficult for the Fed to cut rates preemptively given the higher risks for higher inflation. So given the outlook, do you still see a path for a soft landing, and what does that look like?
Well, let me say, so let's look back and see where we are. So to go through 2024 up to the day, we've had unemployment in the low 4s for more than a year. We've had inflation coming down now in the mid to low 2s. We've had an economy growing at 2.5%. So that is the economy as we see it now. What looks likely, given the scope and scale of the tariffs, is that we will see certainly the risks to higher inflation, higher unemployment have increased. And if that's what we do see, if the tariffs are ultimately put in place at those levels, which we don't know, then we won't see further progress toward our goals. But we might see a delay in that. I think in our thinking, we would never do anything but keep achieving those goals. But we would, at least for the next, let's say, year, we would not be making progress toward those goals. Again, if that's the way the tariffs shake out. The thing is, we don't know that. There's so much uncertainty about the scale, scope, timing, and persistence of the tariffs. So that's that. In terms of preemption, I think you can look back at the 2019 cuts as preemptive. I wouldn't say that what we did last fall was at all preemptive. If anything, it was a little late. But 2019, we did cut 3 times. But the situation was you had a weakening economy and you had inflation at 1.6%. So that's a situation where you can move preemptively. Now we have inflation running above target. It has been above target for 4 years. It's not so far above target now. And we have an expectation, conditional on what happens, that we'll see upward pressure on inflation. If you look at where forecasters are, they're all forecasting an increase in inflation. So it makes it, and then we've also got forecasts of weakening in the economy, and some have recession forecasts. We don't publish a forecast about that. We don't publish a forecast that assesses how likely a recession is. But in any case, it's not a situation where we can be preemptive because we actually don't know what the right response to the data will be until we see more data.
Colby Smith with the New York Times. How much weakness does the committee need to see, though, in the labor market and the economy more broadly to lower interest rates again? Is it about a certain increase in the unemployment rate over a period of time, or perhaps a certain number of negative monthly job reports? I mean, how are you making that assessment?
So first of all, we don't see that yet, right? We have 4.2% unemployment, good participation, wages behaving very well, participation, I mentioned, at a good level. So, with the labor market, we would look at the totality of the data. We'd look at the level of the unemployment rate. We'd look at the speed with which it's changing. We would look at the whole huge array of labor market data to get a sense of whether conditions are really deteriorating or not. And And at the same time, we'd be looking at the other side of the mandate. We could be in a position of having to balance those two things, which is, of course, a difficult balancing judgment that we'd have to make.
On that point about balancing, I mean, you've mentioned that the committee would consider how far the economy is from each goal and the time it would take to kind of get back to that point. But what does that mean in practice? I mean, how much of that assessment will be rooted in a forecast versus data dependence?
It would be a combination of the two. I mean, let's just say this would be a complicated and challenging judgment that we would have to make. Yeah, we're not in this situation, but the situation is if the two goals are in tension. So let's say that unemployment is moving up in an uncomfortable way, and so is inflation. That's not the situation we're in, hypothetically, but we would look at how far they are from the goals, how far they're expected to be from the goals, what's the expected time to get back to their goals. We'd look at all those things and make a difficult judgment, and that's in our framework. It's always been in our thinking. You know, we haven't faced that question in a very long time. So again, difficult judgment to make, and not one that we face today. We may never face it, but you know, we have to be keeping it in our thinking now.
Edward.
Thank you. Edward Lawrence with Fox Business. So we had the CPI report that came out that showed month over month the first decrease in inflation in about 3 years. The jobs report, you said, solid, that we saw. At the same time, we have those new tariffs that we're living under. So given this, should the Federal Reserve be cutting rates at all this year?
You know, it's going to depend. I think you have to just take a step back and realize this is why we are where we are. Is you know, we're going to need to see how this evolves. There are cases in which it would be appropriate for us to cut rates this year. There are cases in which it wouldn't, and we just don't know until we know more about how this is going to settle out and what the economic implications are for employment, for inflation. I couldn't confidently say that I know what the appropriate path will be.
So following on that, just so then how does President Trump calling on you personally, as well as the Federal Reserve, to make rate cuts affect your decision today and affect your job difficulty?
Doesn't affect our doing our job at all. So we're always going to do the same thing, which is we're going to use our tools to foster maximum employment and price stability for the benefit of the American people. We're always going to consider only the economic data, the outlook, the balance of risks, and that's it. That's all we're going to consider. So it really doesn't affect either our job or the way we do it.
Howard.
Hi, Howard Schneider with Reuters, and thanks for the time. I'm wondering, I mean, given the complexity about the first quarter GDP and what lies ahead, I'm just wondering what your intuition tells you about the underlying direction of the economy right now. Many of your colleagues have said they feel growth is slowing. If so, do you have any sense of by how much, to what degree the slowdown may be? What does your gut tell you about how things are evolving out there?
My gut tells me that uncertainty about the path of the economy is extremely elevated, and that the downside risks have increased. The risk is, as we pointed out in our statement, the risks of higher unemployment and higher inflation have risen. But they haven't materialized yet. They're really not in the data yet. So that tells me more than by intuition, because I think it's obvious actually that the right thing for us to do is we're in a good place. Our policy's in a very good place, and the right thing to do is await further clarity. And there's usually things clarify and the appropriate direction becomes clear. That's what usually happens. Right now, it's very hard to say what that would be. In the meantime, the economy is doing fine. Our policy isn't, it's not highly restrictive. It's somewhat restrictive. It's 100 basis points less restrictive than it was in, last summer. So we think it's in a good place, and we think the appropriate thing is for us to wait and see and get more clarity about the direction of the economy.
Well, let me press you on this idea of the economy being fine right now, because reading the Beige Book very closely the last time around, there was a lot of negative stuff, negative sentiment that was in there, and I know that everybody's looking at soft data right now. You mentioned it yourself that the sentiment's sour. But the Beige Book was talking about, the beginnings of layoffs in some industries, prices rising in some places, and an awful lot of investment decisions being pushed to the sideline. Doesn't that point to a slowdown?
It may well. It just hasn't shown up yet. And we all look at all these sentiment and read many individual comments just to get a better feel. And businesses and households very broadly are concerned and postponing economic decisions of various kinds. And yes, if that continues and nothing happens to sort of alleviate those concerns, then you would expect that to begin to show up in economic data. It wouldn't maybe show up overnight, but it would show up over weeks and months. And that may be what happens, but it hadn't happened yet. And also there are things that can happen that will change that narrative. I mean, they haven't happened, but it's possible to imagine things that, but in the meantime, yes, we're watching it extremely carefully like everyone is, but don't see really much evidence of it in actual economic data yet. And by the way, consumers keep spending, credit card spending. It's still a healthy economy, albeit one that is shrouded in some very downbeat sentiment on the part of people and businesses.
Michael McKee from Bloomberg Radio and Television. The Fed's been criticized recently by a former governor for what he calls mission creep. You take on more problems, use more tools, and then end up building tools to deal with the fallout of those tools, which then makes it a given that you will act more aggressively in the future. Is that a fair critique, and is that something you would be looking at in your framework review?
Sorry, say the critique again.
That the Fed has been involved in mission creep, gets involved in using too many new tools to deal with problems and to go too far. Is that something that the critique was based around the fact that you did QE and QE and QE and went beyond the narrow confines of your mandate?
So, well, I mean, there are a couple. That's not really beyond the confines of our mandate. I would say this: we did things. Essentially, we're on an emergency footing for a couple of years in the pandemic, and it's very fair and very welcome for people to look back over what we did and say, hey, you could have done this better and different. And one thing we hear a lot is we could have explained QE a little better. We did think we were explaining it in real time. I completely accept the thought that we could have explained it better. There's a lot of thinking that we went on too long with QE. I can tell you that the reason we did was we were concerned that we didn't want a sharp tightening in financial conditions at a time when we thought the economy was still vulnerable. And so we did hold on for a long time to QE, and we of course tapered and everything. And then we immediately went into QT, and we're down a couple of trillion. But I get we certainly, with the benefit of hindsight, could have tapered earlier or faster. That's absolutely right. But this is all very welcome. We knew doing this in real time that we weren't going to get it perfect, and those kind of after action kind of looks are essential, and we're doing the same thing in our review. So on some issues.
The other part of that critique is that you've taken on topics that are outside of the mandate, such as climate change and trying to ensure that certain groups are benefited by your economic policies in terms of employment, et cetera.
So, okay, on climate, you've heard me say over and over again that we will not be climate policymakers, and that our role on climate is a very, very narrow one. And I think that's what we've done. We've done really very little on climate. You can say that little bit that we've done was too much, but I wouldn't want to give any impression that we've taken climate and it's something that we're spending a lot of time and energy on. We're not. We have very, very narrow things. We did one guidance for the banks, and then we did a one-time stress analysis, climate stress analysis, and that's it. And we dropped out of the network of the financial system. So we didn't do much on climate, but I do think, and I've said this publicly several times, I think it's a real danger for us to try to take on a mandate like that, which is very narrow application to our work. And the risk is if you go for things that are really not in your mandate, then why are you independent? And I think that's a very fair question. I do think we've done a whole lot less on climate than some people seem to think we did. Anyway, that's what it is.
Should you have taken on the question of bringing unemployment rates down for specific categories?
We didn't do that. What we said was that we never targeted any unemployment rate for individual racial or demographic groups. What we said was that maximum employment was a broad and inclusive goal. And I think what we meant by that was we're going to consider the totality of the country as we look at our maximum employment goal. Of course, we were never going to target any individual group with that, but I think some people, wanted to hear it that way. But that's not at all what we meant. So that's just not a correct reading of our. But I can see how maybe people found that confusing, and we have to take that into consideration.
Jolene.
Hi, Chair Powell. Thanks for taking our questions today. I'm Jolene Kent with CBS News. You said wait and see, and the economy is doing fine today, but the impact of tariffs are already showing up at the ports. Businesses big and small are telling us that they feel it, and most importantly, consumers say they feel it, that the challenges are here, and there's no waiting and seeing. For Main Street, what is the breaking point? What would have to happen to prompt a rate cut specifically?
Well, so we really don't see in the data yet big economic effects. We see sentiment, there are concerns that higher prices may be coming or things like that. So they're worried now about inflation. They're worried about a shock from the tariffs, but they really haven't. That shock hasn't hit yet. Okay, so we're going to be looking at the not just the sentiment data, but also the real economic data as we assess what it is we should do. And remember, there'll be two effects. One of them would be weakening economic activity, which translates into higher unemployment, and the other would be potentially higher inflation. Again, to say it again, the timing, the scope, the scale, and the persistence of those effects are very, very uncertain. So it's not at all clear what the appropriate response for monetary policy is at this time. And and by the way, our policy is in a good place, so we think we can wait and move when it is clear what the right thing to do is. Really not at all clear what it is we should do. So people are feeling stress and concern, but unemployment hasn't gone up. Job creation is fine. Wages are in good shape. People are not layoffs, or people are not getting laid off at high levels. Initial claims for unemployment are not increasing, in any kind of impressive way. So the economy itself is still, in solid shape.
Just a quick follow-up. President Trump now says he does not plan to remove you as chair. When you heard that, what did you think?
I don't have anything more for you on that. I've pretty much covered that issue. Thank you.
Chris.
Hi, thank you. Chris Rugaber, Associated Press. Well, I just wanted to follow up. Earlier, it sounded like you said it was unclear how the Fed, what kind of interest rate decisions you will make later this year. So does that, in March, there was guidance that 2 cuts might happen, 2 cuts were penciled in for this year. Is that now, that guidance from the last press conference, has that been overtaken by events at this point?
We don't do a summary of economic projections at every meeting, as you know. We do it every other meeting, and so this was the meeting when we didn't do it. We don't also kind of poll people, so I really wouldn't want to try to make a specific projection for where we are relative to that. We will, in 6 weeks, we have the June meeting, and you'll have another SEP. I'm not going to hazard a guess here today as to what it would be. Again, what I would say is that we think our policy rate is in a good place. We think it leaves us well positioned to respond in a timely way to potential developments. That's where we are. And that, depending on the way things play out, that could include rate cuts. It could include us holding where we are. We just are going to need to see, how things play out before we make those decisions.
Great. And just to follow up on that, I mean, when you address the issue of how the Fed would handle both rising unemployment and rising inflation, how are you thinking about the fact that addressing one could exacerbate the other? So a rate cut to reduce unemployment could worsen inflation and vice versa. How do you handle those challenges?
You just captured this is the issue with the two goals being in tension. It's a very challenging question. Now, there can be a case in which one goal is very far, one variable is very, very far from its goal, much farther than the other. And if so, you concentrate on that one. And frankly, that was the case. Well, it wasn't a case where they were really in tension. But if you go back to 2022, it was very clear that we needed to focus on inflation. The labor market was also super tight, so it wasn't really a trade-off. If I think you know what our framework document says. It says we'll look at how far each variable is from its goal, and also we'll factor in the time it would take to get there. So, that's going to be potentially a very difficult judgment. But the data could break in a way that it's not. I just don't think we know that. The data could easily favor one or the other. And right now, there's no need to make a choice, and no real basis for doing so.
Victoria.
Hi, Victoria Guida with Politico. I wanted to ask, Congress is currently debating spending cuts alongside extending the tax cuts. And I know you've talked many times about how the path of the debt is unsustainable, but given that we're also talking right now about the economy slowing, potentially even recession, I was just wondering, is there a danger that spending cuts now could slow growth a lot more?
We don't give Congress fiscal advice. We take what they do as a given, and we put it in our models and in our assessment of the economy. So I wouldn't want to speculate on that. I mean, I think we do know that the debt is on an unsustainable level, on an unsustainable path, not at an unsustainable level, but an unsustainable path. And it's on Congress to figure out how to get us back on a sustainable path. And it's not up to us to give them advice.
Or do you think that they should take macroeconomic conditions into account as they look at this?
I think they don't need my advice and our advice on how to do fiscal policy any more than we need their advice on monetary policy.
Andrew.
Thanks, Mr. Chairman. Andrew Ackerman with the Washington Post. In your Jackson Hole comments last year, you said you would not welcome further cooling in labor market conditions. The unemployment rate then was 4.2%, which is what it is now. Many forecasters now predict a higher jobless rate. How has your tolerance for weakening labor market conditions changed compared to a year ago?
So it was quite a different situation. What was happening last year is that over the space of 6, 8, 7 months, the unemployment rate went up by almost a full percentage point. And it was click, 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 click each month. And everywhere people were talking about downside risks to the labor market. At the same time, payroll job numbers were getting softer and softer. So there was a really obvious concern about downside risk to the labor market. And so at Jackson Hole and then in September, we wanted to address that forthrightly. We wanted to show that we were there we'd been there for inflation for a couple of years, and we wanted to show also that we're there for the labor market. And it was important that we send that signal. Fortunately, since then, the labor market has really, and the unemployment rate have really been moving sideways at a level that is, well in the range of mainstream estimates of maximum employment. So that concern has gotten a lot less. So you're at 4.2% unemployment. I think we were in a very different situation. Now we have a situation where, the risks to higher inflation and higher unemployment have both gone up, as we noted in our statement, and we've got to monitor both of those. We actually have a potential situation where there may be a trade-off or tension between the two, potentially. We don't have it yet, and we may not have it, but that's what we have, and that's why I think it's a very different situation.
I guess I want to follow up by asking how much of a rise in the jobless rate you could tolerate.
I can't give you I'm not going to try to give you a specific number. I'll just say we have to now be looking at both variables and which of them is demanding. If one of them is demanding our focus more than the other, that would tell us what to do with policy. If they're more or less, equally distant and equally, or not distant, then we don't have to make that assessment. The assessment is you wait. So I'm not going to try to be really specific about what we need to see in terms of a number. But if we did see significant deterioration in the labor market, of course that's one of our two variables, and we would look to be able to support that. You'd hope that it wasn't also coming at a time when inflation was getting very bad. And again, we're speculating here. We don't know this. We don't know any of these things. It's very hypothetical. We're just going to have to wait and see how it plays out. Thanks.
Hey.
Claire Jones, Financial Times. In terms of getting some clarity, we've got some talks at the weekend in Geneva between the US and China. A lot of economists are attaching an awful lot of importance to what we hear from those talks. How much importance are you attaching to them in terms of judging what will happen to the US economy going forward? And just in a similar vein, some economists are saying it's days, not weeks, that we have until we start to put the US economy at risk of seeing the sort of pandemic era shortages and higher prices if we don't kind of soothe relations between the US and China. So it'd be good to have your view on that too.
So, these are not talks that we're in any way involved in, so I really can't comment directly on them. So, but what I will say is this, we had, coming out of the March meeting, the public generally had an assessment of where tariffs were going, and then April 2 happened, and it was really substantially larger than anticipated in the forecasts that I had seen and in our forecasts. So, and now we have we're in a new phase where it seems to be we're entering a new phase where the administration is beginning talks with a number of our important trading partners, and that has the potential to change the picture materially or not. And so I think it's going to be very important how that shakes out. But we simply have to wait and see how it works out. It certainly could change the picture, and we're mindful of not trying to make conclusive judgments about what will happen at a time when the facts are changing.
And just on the fall in shipping volumes from China over these tensions, I mean, do you share that concern that we could start seeing goods shortages and higher prices in the coming weeks if this isn't resolved very quickly?
I don't want to get we shouldn't be involved even verbally in questions about the timing of these things. Yes, of course we follow all that data. We see the shipping data, we see all that, but ultimately this is for the administration to do. This is, this is their mandate, not ours. And I know as you can see, they're again beginning to have talks with many nations, and that has the potential to change the picture materially. So we'll just have to wait and see.
Kosuke Takami with Nikkei. Thank you for doing this. The volume of imported goods increased significantly in the first quarter. Do you think that this situation could cause a delay in the impact of tariff on inflation? And does this mean that it will take longer time to reduce uncertainty?
The decision we made today? Which decision?
So the future decision. So the volume of the imported goods has increased significantly. So the impact on the imported inflation may delay. So what is the impact to your future decision?
Okay, so I mean, I think we think that there was a big spike in imports, right? Very big, historically large, really, and to beat tariffs. And now that should actually reverse, so that it's the difference between it's exports minus imports. So and imports were huge, and so that it conveyed a very negative contribution to U.S. GDP, annualized GDP in the first quarter, as we all know. So that could, in the second quarter, be reversed, so that we have an unusually large contribution to usually positive. That's very likely as imports drop sharply. You could also have very likely you'll have restatements of the first quarter. It'll turn out that consumer spending was higher. It'll turn out that inventories were higher, and so you'll see those data revised up. It may actually go into the third quarter too, and so I think this whole process is going to a little bit make it harder to make a clean assessment of U.S. demand. I mentioned private domestic final purchases, which doesn't have inventories government or inventories government. Anyway, it's a cleaner read on private demand, but that too probably was flattered a little bit by by strong demand for imports to beat tariffs. So that might overstate. It's a really good reading, 3% PDFP in the first quarter. That might actually overstate. So it's not really going to, I don't think it's going to affect our decisions. I will just say though that it's a little confusing, and it's probably less confusing to us than it would be to the general public as we try to explain this. It's complicated, and GDP is sending a signal, PDFP is sending a signal. It's a little bit confusing, but I think we understand what's going on. It's not really going to change things for us.
Courtney Brown from Axios. I guess, we talked about some of the indications of potential layoffs, price hikes, an economic slowdown, all being evident in the soft data. I'm curious why the Fed needs to wait for that to translate into hard data to, make any type of monetary policy decision, especially if the hard data is not as timely or might be warped by tariff-related effects. Are you worried that the soft data might be some sort of false warning?
No, I mean look at the state of the economies. The labor market is solid, inflation is low. We can afford to be patient as things unfold. There's no real cost to our waiting at this point. Also, the sense of it is we're not sure what the right thing will be. There should be some increase in inflation. There should be some increase in unemployment. Those call for different responses, and so until we know, potentially call for different responses. And so, until we know more, we have the ability to wait and see. And it seems to be a pretty clear decision. Everyone on the committee supported waiting, and so that's why we're waiting.
Just a very quick follow-up. There was this sort of vibe session, if you will, where the sentiments expressed in soft data did not translate into the hard economic data. How are you thinking about that when interpreting some of the signs in the softer survey data?
I think going back a number of years, the link between sentiment data and consumer spending has been weak. It's not been a strong link at all. On the other hand, we haven't had a move of this, speed and size. So it wouldn't be the case that we're looking at this and just completely dismissing it. But it's another reason to wait and see. You're right, though. We had a couple of years during the pandemic where people were saying just very downbeat surveys and going out and spending money. So that can happen, and that may happen to some degree here. We just don't know. This is an outsized change in sentiment, though, and so none of us is looking at this and saying that we're sure one way or the other. We're not.
Matt.
Thanks, Chair Powell. Matt Egan with CNN. So you mentioned earlier that you're monitoring the shipping data, and we have seen in the shipping data that imports from China into the Port of Los Angeles have plunged, and that has raised concerns about potential shortages. What tools, if any, does the Fed have to ensure that prices and inflation expectations don't get out of hand if tariffs do cause significant supply chain disruptions?
I mean, we don't have, the kind of tools that are good at dealing with supply chain problems. We don't have that at all. That's a job for the administration and for the private sector more than anything. What we can do with our interest rate tool is we can be more or less supportive of demand, and that'd be a very inefficient way to try to fix supply chain problems. But we don't see the inflation yet. We're of course reading the same stories and watching the same data as everybody else, and right now we see inflation, kind of moving sideways at a fairly low level.
If I could follow up on that, President Trump has indicated that he will likely name a replacement for you when your term as chair expires next year. But your position on the board runs through January 2028, I believe. Would you consider remaining on the Fed board even if you're no longer chair?
So I don't have anything for you on that. My whole focus is on, and my colleagues' focus is all on, trying to navigate this tricky passage we're in right now, trying to make the right decisions. We want to make the best decisions for the people that we serve. That's what we think about day and night. And this is a challenging situation, and that's 100% of our focus right now.
Let's go to Jennifer for the last question.
Much, Chair Powell, Jennifer Schonberger with Yahoo Finance. Public records of your schedule so far this year show no meetings with President Trump. Past presidents Obama, Bush, and Clinton have all met with Fed chairs, and you met with Trump during his first term. Why haven't you asked for a meeting yet with the president?
I've never asked for a meeting with any president, and I never will. It's not. I wouldn't do that. There's never a reason for me to ask for a meeting. It's always been the other way.
So would you want to meet with him if given the opportunity?
It's never an initiative that I take. It's always an initiative. I don't think it's up to a Fed chair to seek a meeting with the president, although maybe some have done so. I've never done so, and I can't imagine myself doing that. I think it's always comes the other way. A president wants to meet with you, but that hasn't happened.
And if I could just ask one question on monetary policy, when it is time to cut rates, how will you determine how far down rates will have to come to try to keep a balance on the inflation mandate as employment weakens?
I think once you have a clear direction, you can make a judgment about how fast to move and that kind of thing. So it's really the harder question is the timing, I think, and when will that become clear? And fortunately, as I mentioned, we have our policy in a good place, the economy's in a good place, and it's really appropriate, we think, for us to be patient and wait for things to unfold as we get more clarity about what we should do. Thanks very much.
Okay, it is all over. Started to get some volatility towards the end right there, didn't we? Boy, it still doesn't want to hold or move though. I was ready to like confirm this thing was going down to a much lower fib level. I've been agreeing with everybody that thinks we should potentially make a bigger pullback. I still feel like we should at least go down to 38, maybe even all the way down to one of these much lower fib levels. Yeah, we definitely got some moves on shorter time frames, definitely. Boy, the higher time frames are just not holding though. Let's see. Boy, your Fibonacci extension on there. Oh, not even close. Let's see. Yeah, it's right at the 123%. So definitely still could be a wave C, I guess. Looked pretty impulsive, but if it starts to really pull back, I mean, it definitely still could be an ABC. If it goes much lower than it already is, then that's definitely not an ABC, but it's a 1, 2, 3. Your Fibonacci extension is what normally will tell you the difference between an ABC and a 1, 2, 3. Also, you can use your base channels to help you with that too. Let's throw a base channel on there, see if it's broken out of that yet. Let's see, your base channel is for your 1, 2, 3 or ABC. Oops, I kind of messed it up. It does look like it might be breaking now. Maybe something like that. Yeah. Maybe not yet. Pretty close. If you break the base channel, it's supposed to confirm 1, 2, 3. If it goes out and then just pulls back within the base channel, then it's not a 1, 2, 3. It's probably an ABC. It's probably going to stretch out into an ABC because, like I've been saying, I mean, I totally agree with anybody that thinks this thing's due for a pullback. I mean, we're right at resistance. I just seen these situations before where you think it's going to go down and it doesn't. And then you end up missing the long opportunity if you're not careful. US dollar CAD hasn't even broken structure of this high right here. I mean, it still could be an ABC. If it breaks this high right here, then I definitely would confirm that we're in a bigger move to the upside. If it doesn't break that high, then it's probably not really confirmed anything. Except for the higher time frame trend is still active. Aussie dollar and Kiwi dollar definitely look like they're breaking structure. Aussie dollar definitely gave us a pretty decent break of structure, which I think should confirm that this is potentially an ABC right here. This potentially would be a wave A, right? 1, 2, 3 waves of A, 1, 2, 3 waves of B, either a running or an expanding. If it's an expanding, it's probably going to go all the way down to like right here for wave C and then continue the uptrend. If it's a running ABC, then it might make a higher low and then continue the uptrend, higher low compared to the wave A. Definitely no way of telling the difference until it happens. You just got to watch out for both. Which means the Kiwi dollar is probably something pretty similar. Someplace in here, there's probably an A, there's probably a B. Probably now going to go down to at least a 38%, I bet, for wave C. That's more of a traditional ABC. It's just that 1, 2, 3 of B, 1, 2, 3 of A, 5 waves of C. So, like I've been saying in my videos, I mean, it would make total sense for this thing to go down. It's just you got to be careful in these situations because these very high time frames, you know, this at the end of this month, we could be looking at a bullish candle on the higher time frame. So, just keep an eye. Definitely bearish for now. I mean, the euro dollar has made an engulfing move to the downside on the daily right there. It started to engulf up also, but it really wasn't able to hold, was it? So, yeah. Based on structure, the trend is up. Based on market flow, the trend is definitely down. Boy, not very strong moves. So see what these do over the next few hours. Aussie dollar and Kiwi dollar look like good movers. US dollar CAD, I totally think it would make sense for this thing to go all the way up and take out these highs before it went down. Or maybe even make a much bigger pullback than that, but that's the minimum I would expect. US dollar Swiss, same type of thing. I would expect to see this go up to like 50% maybe, and then continue the downtrend. Gold, yeah, I mean, I could see many possibilities for gold. I kind of feel like because it went past that level that this is a wave C that's going to go up to these areas and then go down like that. Almost like a WXY, isn't it? 1, 2, 3 waves up, 1, 2, 3 waves down, 1, 2, 3 waves up. And probably a WXY of B if I had to guess. I think that's my best guess on gold. WXY of B and then down for a C, and this is still a wave 4 in the higher time frames. And US dollar yen, yeah. Really depends on what the dollar is going to do. I mean, the dollar yen hasn't even engulfed on the daily yet. So, I mean, this thing could still go down for sure. The problem with the US dollar yen is they made what almost looks like a perfect ABC. Now, if it's actually a running, like this is an ABC running, and then it goes up again and then down, that's also a very common pattern in the market. If it does do that, which I guess it definitely could be possible, right? Because here's your ABC. Boy, I don't know. That really doesn't look like a way B to me, though. That would have to look like a way B for that to be true, and it really doesn't look like a way B. It just looks like 1, 2, 3, 4, 5 up, A, B, C down, 1, 2, 3, 4, 5 up, break a structure. I bet this is going to keep going down, in my opinion. Yeah, I got in like a Starbucks money trade on the euro dollar, but nah, usually don't really try to trade these events. Even though they usually are pretty big turns when the market agrees, definitely. What does the stock market do? Oh, boy, it's rejecting structure. This is an important area on the stock market. I think if it breaks that low right there, it definitely could keep going down. Keep an eye on that, definitely. I tried to go long on the euro dollar, but it was like a $50 risk on a $100,000 account. It was just, I don't really trade these news events. I went long right there. Got out like right there. So it was like a $50 loss on a $100,000 account. So definitely not too concerned with that. I don't really, if I do trade these news events, it's usually pretty small. Now after like an hour or two, keep an eye on it because it still could end up being an ABC correction. That's what I was looking at it as this spike right here. I was thinking could have been a wave C and it might keep going up, which it still could be an ABC. That's what the Fibonacci extension and the base channel is potentially good for. But you can kind of see that it already broke the base channel, I think. Yeah, no, not really. Yeah, the base channel is supposed to tell you the difference between an ABC and a 1, 2, 3. It doesn't have to be an ABC. It could be a 1, 2, 3 for sure. That's what I'm saying. This could be a 1. This could be a 2. Or this could be an A, just kind of like what Stefan put in the members chats a little while ago. This could be an ABC. This could be a 1, 2, and this could keep going down for wave 3. So, yeah, I mean, definitely looks like that. Keep an eye on your fibs. Keep an eye on your channels, stuff like that. Anyways, I'm going to go eat dinner, and then I probably will make my PM videos after that. Exactly, I agree. Price pretty much takes everything into account, price action. I don't really pay too much attention to fundamentals, but these bigger news events do sometimes cause some pretty big turns. So, anyways, I'm going to go eat some dinner. I will talk to everybody later on. As always, don't forget to like and subscribe. And as always, thank you.